Welcome back and welcome to the outdoor edition. So occasionally we may switch it up inside the office, outside the office. Today's a nice warm day here in Babcock Ranch, Florida, if anyone has visited before. But Florida has been receiving, we've been in the mid 90s the whole week. I'm not complaining. I'm a up north guy. We're used to having the four seasons, but decided to take the plunge and head down to Florida like everybody else, and now we're here, so I can't complain about the heat. So, and then Quinn is also in town as well, a different part of town, but experiencing some of that record heat. And occasionally, I think we'll be seeing some forecasts of some rain sometime next week. But anyone who has joined the weather this summer, early summer, uh, love to hear your stories about that. Put that in the chat. And again, thank you everyone for been purchasing the book, the Net Lease Playbook. We've been again tremendous feedback so far from our investors, um, buyers, sellers, and alike. That's been getting some good insight out of it. And like I said, it's been just a accumulation of information, feedback, trials, tribulations that we've been learning over many transactions, as well as feedback from our investors to kind of tighten it up. And again, it's not me as kind of a guru per se putting out information. Is more learning from each and every single transaction over the course of the years through constant feedback that I get from investors and clients. So again, we appreciate it. Uh, be sure to leave us a review. And again, anyone who grabs a copy and wants to get some bonus material, which I think is the bread and butter of the book, is behind the scenes. Of course, you can read about this and study as much as you can, but actually being in the game, doing the deals. So the closest you can get is hear from experienced investors, experienced attorneys, mortgage lenders that do deals all the time, that go through multiple case studies and have different types of trials and tribulations throughout different transactions that you can get wisdom from to minimize mistakes and get you to your goal a lot quicker. So again, send me an email at dclark@americanetlease.com. I'll put you on this email list, which we send out specifically for people to get this kind of content. And again, that includes us doing deep dives on Zoom for leases. Occasionally, we'll bring on attorneys, lenders, and experienced investors to kind of share their insight and take. It allows you to ask questions and be able to just really get as much knowledge and wisdom without actually having to make any mistakes. So we appreciate that, and we'll continue on that. So today, so we're about third day in. We're going to be doing this till Friday, same time, 2 p.m. And we'll see kind of the feedback. So far, it's been pretty good. Doing at 2 p.m. Eastern for people to kind of check out either the live stream or the replay. So now and we've been covering news throughout the week. Obviously, it's not like anything's unexpected. It's the continuation. We have House bills going through Congress, being negotiated. So we're kind of monitoring that as best as we can. And what we're really interested in, as far as kind of items that will stimulate the economy, make things more, I say, affordable on the purchase side for investors to get involved, as well as on the flip side for the sales side to make sure you get good valuations on the sales side, as well as monitoring any type of modification of the tax laws where I say a good 75, 80% of our investors are utilizing it to a degree, either through the 1031 exchange, depreciation, cost segregation, things of that nature. So far, from what we've been reading, none of those stuff will be touched. They'll be kind of expanding on the 2017 tax cuts, and just that would help illuminate the economy, which then will benefit the tenants, which then will benefit the property owners. And again, also, along with just doing the research on the top side on the federal market, you got to look at each individual state that you look to invest. We, of course, get a lot of popular demands for a lot of these tax friendly states, such as Texas, Florida, Tennessee, those things. So you also want to monitor those. And then when we see any specific news that pertain to that, we'll bring it on the live and we can discuss it. especially if you're kind of hyper focusing on that. So we would love to kind of get your feedback, so then we're able to then share that with the audience, and then you get the benefit because now it's going to be on record. So again, so now going back, so that not much since yesterday changed outside of the Treasury yields did increase, and again, that's due to, like I said, economic uh, perceived uncertainty. And again, they're talking about a potential rate cut in June or July. But then we're going to talk about that a little bit later when with one of our frequently asked questions that we have on the docket in regards kind of how do you make decisions based off of that, and you really can't time the market. So it's really about how you buy, how you underwrite, and how you look towards to the future. So right now, let me see if I can share my screen just to give you a quick look at what we're talking about. But again, it's nothing that isn't expected. So right now we're at 4595, so it's jumped up quite a bit. Um, so again, what does that really mean? That's going to affect borrowing costs, which then affects purchasing ability, and also valuations, as it will increase cap rates of properties, which then decrease the valuations of properties. So depending on which side of the fence you are, on a buyer or a seller, this is going to have some type of effect. And again, we want to make sure that whichever side that you're going to be acquiring, you want to make sure you have all of the right data, so you can be able to kind of properly prepare yourself as you move forward. So, so what else I had was, oh, the big thing is about the U.S. credit downgrade by Moody's, and we've got some follow up questions in regards to that, and how does that affect net lease. And again, that's the United States credit. So we look at a lot of these uh, tenants that have Moody's and S&P credit, and we kind of value as far as how stable that tenant is, and of course that affects the valuation of it. We were talking about the United States government, and a big due to that is how much debt we got. We got over $35 trillion in debt. So this is not something that wasn't expected to happen. When you carry that much debt, and of course the state of the economy, and again all of this stuff um, accumulated very, very rapidly since COVID-19, and then since then it's just continuous spending. And if you look at as far as our expenditures, we have Medicaid, Medicare, all of these type of stuff. I think is the total is around 86% of the total budget, and that's not budget. So this administration kind of put forward as far as the budget, as far as no cuts to that. So that's going to be moving forward. And right now there's some intense negotiations going on between the many caucuses, and we'll see where that ends at. But at the end of the day, it still doesn't affect, or it does affect to a degree. But when we talked about reverse engineering to meet your specific goals, as well as proper underwriting, so there's more clearer expectations, you want to make sure that that's in place, and you kind of stick to that. And then we'll try to find deals that match that. And again, there might be scenarios based off of your current setup, your expectation, that you may end up having to hold and not do anything, which is fine too. But at the end of the day, you want to make sure that you're not put into a position where you're either rushing and making mistakes, but you have all of the clear data, and you're going to be happy, or at least more content with your decision. So those are the kind of two major headlines. And then today on the agenda, I have again about five really good frequently asked questions that came through email. We're going to discuss that, and then we're going to also going to discuss in our educational segment. And again, this is not going to be too long, and we appreciate your patience through this, as it's just so much information that I need to share. And I'm typically just spitting this out on conference calls and Zoom. And I say, hey, let's just do this on a live every day. Everyone gets the benefit. You can watch this at your leisure. We encourage people to join on live, and again, just chime in, ask any questions. So then we're both all learning together, and then we can kind of spread this message to as many investors as we possibly can. Our goal is to help at least 1,000 investors for next year, to make some sort of decision on the buy, sell, or invest side. And again, we're just trying to put as much content so then you have as much information to make sound decisions. We do have a lead magnet, and again, we've been trying to get them things prepared. It'll be a special web page where then you'll be able to just put your email and just your name and email, and then we'll shoot you over a copy. They're about 10, 15-page ebooks that kind of break down in with conjunction with the presentation that I'm going to give today. And again, we also encourage to go to Amazon, grab a copy of the book, and then just kind of add that to your repertoire of further education. So I'm trying to cut down on majority of the work that you have to do by me having to go dig into the numbers, dig through the weeds. I'm scanning through X, scanning news articles, trying to interpret this data, trying to read through these large bills, trying to see where is the opportunities, where it makes sense. So then you'll be able to have all the information you need to make the proper decision. So
Hey, Dwayne, as a new net lease investor, can you recommend or do you recommend any sources that they can go see any type of news as in regards to the market at all?
uh, any and everything, but I'm on at least from just numbers standpoint. You're seeing where certain companies are trading, CNBC, any other stock trading stuff. I mentioned a couple calls ago that you want to get set up a Google alert and start putting in a whole bunch of tenants, especially the ones that you're interested in. We hyper focus on essential need tenants. So you put in like CVS, you're putting all these medical office tenants, you're putting like some of the quick service restaurant tenants in there, and just start scanning the news because I would have hyper focused on a lot of the big major news outlets. You want to be able to find stuff that's local, that has real intimate knowledge of these businesses and these communities. So you'll be able to draw information from them. So you'll be able to have a better, because especially we're not just, obviously we're looking at national brand tenants, but we're investing locally. So you want to make sure that you're looking at certain subsectors of the market. Here we're in Southwest Florida. We have like Wink News, and we have other news outlets, and you can kind of find out as far as zoning laws, tax proposals, things that's going on locally, and then be able to kind of understand where traffic flow is going, where population is increasing, and you can better have a better feel. So then when it comes time to pull the trigger on a deal, you feel a little bit more comfortable because you've been kind of doing your research. A couple other places I use. I mean, it's like 20, 30 websites. A good source is X because you get a lot of different journalists, a lot of different news outlets that's posting to the platform. And if you're going in and properly set up your alerts, follow certain accounts, you'll just be able to draw information. Of course, we can get very confused and upset with a lot of the political dialogue that go along with it. But again, we got to be kind of grown up in a way because we're trying to tread our own future here. So then you go in, filter as much as you can out, and just look for the real news that pertain to what makes sense to you and your investments. So what I'll do is that's a good question. I'll start kind of compiling some additional sources that I use just to kind of glance. For this morning's research, I went through at least 10 websites, and I'm just kind of scanning different outlets, trying to find the meat of the news story and trying to get as much accurate information. And like I said, just trying to be non-biased and just trying to get as much information out that makes sense to do the job as possible. So we'll do that, and we'll send out to the list, or maybe we'll just put as a link, a shareable Google link in this post call notes, so then everyone has an opportunity to take a look at that. And if you got some good sources that you use, put that in the chat and share with the audience because again we're all going to benefit from that. So going back again, just to wrap up the Treasury yield surge, and then where we're at now. So what's the strategy to say counteract that, or at least, like I said, have a game plan? We want to lock in fixed rate financing as fast as you possibly can. So get in touch with mortgage lenders if you kind of have a plan and you're prepared to look at opportunities now. Is get started. So don't wait when you're on the contract or a little bit in the offering stage when when we're not too clear where the yields are. because we need to properly underwrite this stuff, and we need to do it on paper first before we start, really getting out there and being active, because we don't want to get caught off guard if any type of fluctuation happens and then you're sitting there and feeling vulnerable. So again, locking is fixed rate financing as quickly as you can to hedge against any rate hikes. We got to look for properties bare minimum with rent escalation. So there'll be a lot of attractive deals where they may have some kind of inflated rent numbers, but they don't have no rent bumps. That's going to cause issue because again, we always use it as a hedge against inflation. And on market, traditionally, we're going to see at least 10% every 5 years, which is 2% annually. So if we can see that, and I've seen others, which could possibly pencil out as well, but you want to make sure that you at least have that in place so that you know that your rent is going to be increasing to cover debt service and to also pay your residual profit. We want to underwrite these deals assuming, say, 25 to 50 basis points higher cap rate at the exit. So we always look at everything, especially with dealing with 1031 buyers, and they get excited and they're looking at the initial cap rate, and they're not looking at long term because traditionally 10, 15-year net lease properties, depending what type of debt capital stack you have on it, you're not thinking 10, 15 years down the line, but you want to make sure that the scenario that if you had to sell, where would that number be? I also kind of get in and play around with numbers like what my exit costs, assumingly would be, so you have an idea. And then if it's still cash flowing, then you're really sound. But also set you up on the flip side if you did have to exit, um, that you're kind of in a good position to negotiate, because other buyers are going to look at your asset and they're going to come in at a certain number, and you'll be able to feel comfortable trading that at whatever um, offers that you get that's reasonable.
AD, I'm not sure if you're sharing these on slides, but it's still got the CNBC report up. So
Yeah. I'm still covering Treasury right now.
okay.
So again, that kind of leads into the Moody's downgrades there. So what's the strategy counteracting that? So again, hyper focusing on investment grade tenants. So when you have Moody's cutting the U.S. sovereign rating, I think it's a to a1. I don't know if that's the proper way you got to say it, but yeah, that's the easy way for everyone to understand it. So it kind of dipped down, and again, it's due to rising debt. Our Treasury Secretary said it right a couple Sunday shows ago. Is it's like it's something that was going to occur. I mean, you can't be having this much debt. Just imagine personally, if you just have a credit card with just so much debt. Of course, you have a perceived financial outlook to be more dire than positive, unless you have some type of strong upside in the future to increase revenue. So it's just something that was not something that wasn't surprising to me. Obviously, it does have an effect on the market and affects financing. So you do have to account for that. So knowing that that's on the wall, and like I said, we want to track as many metrics as possible to put you in the position where you can kind of reasonably forecast into the future. And again, we don't want to get too crazy, but yeah, you want to be positioning your underwriting so it covers multiple bases. On the flip side, I get a lot of questions on, what happens if the tenant leaves. It's like, well, let's look at it from a real estate play. Do you have a plan A, B, and C for the building? Is it in a position where not only this tenant should and hopefully continue to do well in this location and pay rent, but will another tenant be able to? If it's not like a building where it has to be completely retroactive, completely redone over, rezoned. So in order to fit another tenant's needs, is it in a nice, highly trafficked area? Does it has great signage? Is it nearby major anchors like grocery anchored centers? Is it near schools, offices, work facilities? What side of the road is on? So those things matter. So then it gives you a little bit more comfort. Not only that, it gives tremendous opportunity to the current tenant to do well in that place and then continue to pay rent. But on a worst case scenario, you'll be able to put another tenant in there sooner rather than later and continue cash flow in a reasonable period of time. So yeah, again, doubling down on investment grade tenants like CVS, FedEx, which are all investment grades, with very strong balance sheets. If they're not investment grade, then where we had talked about a couple calls ago as far as getting a 2.5 before tax profit, and really stress testing the leases for potential economic downturn. Um, we have talked a lot on Zoom calls during the pandemic as far as being in that category of essential need. Those tenants happen to be open and operating and doing quite well during that time. So you want to be positioning yourself with a nice diverse portfolio if you have more than one tenant to do the same. And again, also markets matter. So we're here in a Sun Belt state in Florida where there has been a lot of population influx, which equals more customers, more opportunity, as well as within any of those states to have reasonable business friendly regulations and tax laws that also help. So, stuff that will just be encouraging for businesses, and then hopefully an environment where its citizens can do relatively good, and couple that with essential need that everyone needs to buy each and every day. So my new office that I'm here right now, I need to eat. So consequently, I've been giving this place a lot of business because downstairs I can just go quickly get some food. And in any office environment, people's got to eat, or at the very least, their wives send them over to the grocery store so they can pick up stuff so they can cook. So either which way, you position yourself in in businesses and sectors that will get continued use and not vulnerable to any type of outside forces that can disrupt that at any time. Okay, so last point: stick to bulletproof tenants or more insulated. And again, the good thing about these brands, especially the ones that are traded on stock exchanges, they release earnings reports. They talk about this because they have to express this to their investors to justify more investment and to give confidence into the company. Read these documents. They're going to tell you what their opinion on. You may not agree with it. Sometimes they just make bad decisions. I was seeing something today about Target, and they're kind of blaming this and that and the third. And again, there's a lot of things that needs to be justified because obviously they're a for-profit company. But the good thing is that they're talking about their business plans. You can kind of see if the things makes reasonable sense. Good thing I heard today, or was it yesterday, in regards to Home Depot, where I don't know if it was a restructuring or something they were doing before. Someone can kind of clarify that in the chat if you find that information in regards to their supply chain not to be no more than 10% outside of the country. So meaning they don't have a large amount of their supplies coming from outside of the states. So they're going to be partnering with local suppliers, which again is a good protection against any disruption. So as other companies are trying to re-scramble and try to forecast what their numbers is and then potentially pass on exorbitant amount of cost to the consumer, companies like Home Depot say, "No, we'll keep the cost the same. This is and also have foreseeable profit in the future." So that's really a good thing. That gives a landlord, an investor, a little bit more comfort that okay, this company has a lot of stuff in place to maintain a good business, which then they pay rent. So at the end of the day, these companies have to run their business. But your concern as the owner of the building is do they pay rent? And then is it a sound business for them to pay rent? And those questions have to have more yeses than no. Some of the stuff they may do, you may not agree with as far as like stances, but at the end of the day, can they make profit? Can they make payroll? Can they pay rent? That's really what we stand for. And I know that kind of answers a lot of our recurring questions. I think we had not yesterday or the day before, about Dollar General stock drop and things like that. So that kind of re-answers that question again. And I hope anyone else that's listening or listen to the replay gets some kind of comfort in knowing that. And again, all of that takes is just more research. Okay, so now before we jump into the educational segment, and I'll just make sure to put this on the screen. So you can just hit that Amazon. I think, yeah, I have the links in the description. I don't know if it shows up during yeah, I think it shows up during the live, so you can click on it and give us a shout by just grabbing a copy of that. Um, so while I queue up the FAQs, which I tend to do, I end up answering most of them through the segment, but just want to make sure that everyone kind of gets a little bit more clarification on what we're talking about. And I hope everyone's starting to see the continuous theme of this. It's really about end goal, does it fit your body, being balanced, and legacy. And what do we do to make sure that that legacy piece continues forward? And that takes the work, what we're doing now as far as research, preparation, and planning. So first one, how do rising treasury rates affect? So I'm going to cover that in the presentation. So we'll pause on that one. But again, it really comes down to yes, treasury has enormous amount of effect, but it's really about what are your plans, assuming that you're going to make a decision to move forward on something. So is the U.S. credit downgrade? Yep. So I kind of covered that, and we'll cover that as well. So I appreciate the person who submits that. Should I wait for Fed's cut? So you can't time the market. So I had investors been, you know, not say battling, but a lot of detailed discussions about this, and you just can't time the market. So we been hearing rumors of potential cuts in June or July, but it doesn't outwork the you getting a solid lease with escalations and getting quality pieces of real estate. So the Fed's going to do its thing, and we're going to underwrite as assuming on the worstest case scenario, both in our entry and exit, and just buy the best piece of real estate we possibly can, and also make sure that it meets our metrics as far as what we're trying to achieve out of the investment. Again, compared to other asset classes, more highly conservative, but at the end of the day, it's a certain type of tool that we use that meets a certain investor's need in their investing career. How do I finance NNN deals with rates so high? So it's really we've been doing underwriting for some of our clients, and also for some of the investments we're looking at. So we're going in 50% LTV. That's where we're kind of running our numbers, and we're looking at ranges from where's the latest debt numbers. I don't have it in front of me. Actually, it's yeah, 6.5 to 7.5%. So, and again, that number can change as we see Treasury rates rise. So, as the Fed, as we wait to see where they're going to make their call on what they're going to do, and also seeing where they're also everyone's also eyeing these bills going through Congress and seeing where those end at, and seeing where we're going to be moving into the future. We still got to make moves. So at the end of the day, we want to make sure that we're conservatively underwriting and putting in that meat to make sure that it makes sense. And again, it might be quite thin, but then again, hopefully with all the other elements in place, if it still pencils out, you still feel a little bit more comfort. Because at the end of the day, um, we want to obviously achieve as much profit as possible, but I'm pretty sure everyone's more concerned of making sure you don't have a tenant that don't pay rent. So I'd rather get paid some rent than no rent at all. And that's why we want to make sure that we're properly underwriting this moving forward. So Quinn, on your side, and no questions, everything's so good on there, right?
Yeah, everything's still good. One point I want to bring up, though, I don't know if you remember the client that was looking at that wedding venue. On paper, it looked very good until we got the sales, and then we brought it to Dave. And then, basically, long story short, they wouldn't be able to afford the 20-year lease that they were providing. A lot of times on the OM specifically, it may look good on paper until you bring it to like a mortgage lender or look at the numbers and get the sales, and then you see on the back end sometimes it doesn't make sense.
Yeah, kind of, and we'll allude to that because I do have some presentations in regards to sale leasebacks and where it gives you the ability to negotiate a lot of the terms. In some cases, in this particular case, we were negotiating the rent for the tenant, and they were agreeing to it because they felt pretty optimistic about their business. But at the end of the day, they may be a little bit optimistic. I mean, what business owner is not, ecstatic about their business and think that they're going to do so well, and then things can change. In that case, yeah, obviously we're talking about a wedding venue, triple net, which when we have to pick and choose which we ideally would want, that's on a non-essential side because if you think about it, those are some of the many expenses that people cut if the economy turns south. I mean, I know people's going to still get married. I know people are still going to celebrate, but a lot of those budgets end up getting tremendously cut due to certain actions in the economy and your personal economy. So, but yeah, in that particular case, we'll be covering that in another stream. But you want to make sure that you're penciling out, and it's a good thing. Like we say, always have as the playbook as part of your team, your mortgage lender, that he can quickly able to underwrite certain scenarios, and the best I would say person to look at it is the bank itself. They're the ones putting up the money on this property, so they want to make sure that they're making sure that their investment is sound and that is actually going to be making sense. So in that particular case, when we was kind of penciling out numbers and we're trying to make the numbers work, unfortunately, it doesn't work that way. So, but that'll be another call for another day, and that'll be a good case study. Maybe we can bring up that in particular and answer any question if someone do wish. So next is that cover. Yeah, this is the last one, or this one. Yeah. What is the safest? Was that? Did I do the last one?
No,
How do
you
I
didn't cover that
finance?
one.
Okay, okay. So that one we kind of skipped that one. So that one is how do I finance NNN deals with rates so high?
You just did
So
that.
I just did that one.
Yeah, yeah.
Okay. So, but yeah, just to put a bow on that one, is fixed rate financing is the key. We just want to have predictability, so we want to know exactly what these payments are. Of course, locking in as low as you possibly can at the time, early as you possibly can. The other flip side will be seller financing or sale leasebacks, which we kind of briefly explained. So shopping around different lenders, seeing what rates you can do, and locking terms up early as possible. So that's kind of the name of the game there. Next would be what's the safest NNN type or sector right now, and this is all we focus on, um, unless we're dealing with wedding venues. Essential retail, so grocery, which I'm at two to three times a week getting stuff. Pharmacy, medical tenants, all with long-term leases. So if you hyper focus on those stuff, and if that's where kind of your portfolio mix, you'll be in pretty good shape because again, especially if you're dealing with investment grade tenants. But we kind of have to look at the casual dining sector. And again, I mentioned casual dining as compared to we call QSR or fast food. But QSR can be a mix of fast casual, and you also have fast food, which is like kind of drive through business. But casual dining is a little bit different sector, where it's actually sit down. I mean, I would say between my family, we're dealing with QSR. I mean, we're in and out, and we're in grocery, and occasionally we'll do the sit down with the service and kind of a longer build, and that's kind of more of a planned out type of thing. And again, those are really reactive to economic measures. So people feeling more pinched in the pocket, the economy is kind of going up and down, they start kind of cutting budgets on that. So again, just be mindful of that. Is there still deals out there? Yes. But you just want to make sure that it makes sense. And again, we're putting in our buffers and our insulation tools to kind of keep us safe. But bread and butter, essential retail all day long.
Now, D, would you consider auto and essential retail as well? Because I know some investors, when I talk to them, their their concern is the, as you know, Tesla, like oil change type of tenants. Um, they're thinking obviously not in their lifetime, but I've often heard that they often concerned that automobiles would just go to electric and they won't be in need for those type of auto.
Yeah, we heard that. But again, it's like this. Think of the scenario. I always tell the clients this is that you're always going to have these vehicles on the road to a degree. So you may have an increase of electric vehicles where it might more mandated. Right now is way too expensive. We don't have enough electricity to supply all of this stuff. And again, where are you going to go with all of these vehicles on the road? Say older vehicles, unless there's going to be something where they're just going to take away the car and they're just going to give you electric vehicle for free. You're going to be driving around in that old car. I mean, and then some people you're just not going to convince them to not use their gas car because in some ways some people find it either from a preference or they feel it's more efficient. So we've seen states that try to enact having only all electric vehicles by say 2035 and things like that. And there was always stuff that gets in the way with it. Um, at least for this administration, they're adopting the policy of choice. So right now they're hyper focusing on oil and gas. Will say a next administration or another president push certain policies that way, and then will the sentiment change and will local policies change regarding that? Possibly, but as far as auto service, I think even these services will be adapting because one thing with electric vehicles, they go through tires quite rapidly, and then there's going to be things that's going to be needed to be fixed, modified with them, and it's always going to be something. So it's not going to completely take away. I would see some of these companies adopting and modifying their business model to and again they're looking at this. So I would start reading heavily on any of these industry papers as far as any type of sentiment and plans and investments into these future strategies, and we'll take a deeper look in that since that's a more of a reoccurring question. But at least in our foreseeable future, that's not going to be a thing. And again, we're talking about millions of cars on the road that are gas, millions. I mean, I know people, they still got their old uh, Honda and they Toyota and Lexus they had for 20 years. It's still running good, and they're not changing. They keep doing their services for it. But yeah, it's something to keep an eye on. So that's a good question as well. So to not string this out too long, because we're about 39 minutes in, I'm gonna see if I can get through this presentation. It's not too long. And again, we've talked about this in different chunks over the course of the week. So for me to kind of beat it and belabor it, I don't want to do that, but I do want to get kind of a formal slide deck out. And if anyone wants a specific slide deck, just let us know and we'll shoot that over to you. But like I said, we enjoy sharing this because I'm talking about this all day, and it's been kind of a plan in the making. We've been talking about doing this for a while. So starting here, Fed interest rates and net lease investing. So discover how Federal Reserve policy affects net lease cap rates, financing options, and long-term investment strategies. Presented by me, Dwayne Clark. Yeah, we're just going to go over kind of the basic rules of the Fed and how it affects financing, how it affects purchasing decisions, how it affects the economy, the consumer side that affects the businesses, which then affects potential rent, and how is it kind of a big circle, how interest rates influence cap rates. We've kind of talked about that in chunks. We'll kind of go over it again, and we'll just talk about some actionable advice, which we keep alluding to, but it'll be to the point where you guys will take over because it's real how much information you get comfortable with, and if it work, you're good to go. So, what does the Fed actually control? So, federal funds rate, so the borrowing between the banks between each other, that rate that goes there, but then also affects the borrowing rate that you receive as the borrower, that then affects your purchase on the front end. Two, it impacts treasury yields. Right now, we've been covering. Right now is the 30. I think creeped up to 5%. Right now we're at four and change, 4.583, and again that's fluctuating, which then has effects on the financing policy for banks because we're trying to see where the effects is, and again that's that delta spread of risk. Risk-free investment of the bonds and real estate, and where they kind of meet, and then the tools that they use, which are the rate hikes and cuts and quantitative easing and tightening, which will those are also ways that Feds actually control. So kind of break it down a little bit deeper is the key metrics, cap rates versus treasury yields. So investors just look at this number and they're just trying to line up risk free, which is the United States government, and the cap rate. So ideally, they want, if you're going to take a risk to not invest something in risk free, they have to get a somewhat premium on the real estate side. And traditionally, it's been around 250 to 350 basis points over the 10-year treasury. So that's why we keep kind of harping on that number. And we're just kind of eyeing it to see where's that benchmark. So depending on what side of the fence you are, from either selling, investing, or buying, you want to kind of know where you're at. So then you kind of have an idea from underwriting or pricing out your asset to sell. Um, so obviously that spread, that yield in between, the wider the better. So the buyers, they want higher cap rates. The sellers, they want lower cap rates. So we're trying to find a comfortable medium, I would say, where you can make a deal. Because I've had many deals where it was just more attractive for, in this their particular case, for the investor to just do a treasury than take the risk of a net lease and not get that premium. So right now we had a lot of investors. They say, "Hey, I need six caps. I need five and a half, 5 and 7 to 5 caps in order for it to make sense." And that's very reasonable because again, once we start underwriting this and putting this into play to make sure that the numbers pencil out, it has to have some sort of benchmark which can insulate you on either side. Right now, rates are still there. I think prime is still at 7.5. So loan rates right now, depending on credit, location, tenants, quality, is between 6.5 and 7.5%. So those are the numbers that you want to utilize, and I would say either within that number or on the higher end. So then you kind of see where, if it's still penciled out, it makes sense. And we've been also talking about 50%. Again, we'll get some guidance, and one of these days I have to check Dave Semmer, one of our mortgage lender referrals, to kind of give a little bit of insight of where rates are at, where is he, what is his conversations are with his clients, and what he recommends to borrowers moving forward. So again, you want to make sure that that makes sense. And again, the higher rates equals lower loan to values and stricter debt coverage ratios. So you will need more equity if to make these deals work. So you want to make sure that we're running these numbers and it makes sense, and it can pencil out at the end of the day. So like we talked about before, timing is unpredictable. You just can't time the market. So if you can put in these numbers that on that kind of say, I won't use the word worst case scenario, but very aggressive. So then that you have that type of um, expectation, and it still works. That will make more sense. So, but this still doesn't neglect the basic fundamentals of the tenant strength, the sector, like we was talking about, essential retail, the location, how long the lease term, and rental bumps, and all of the intricate details that make sure that it's more of a safer asset rather than um, possibly like somewhere that's in the middle or potentially risky. And strong cash flow beats out speculation. Again, we want to hyper fixate on that word cash flow. So making sure that thing cash flow, Rich, I always talk about that net lease. It buys your time and provides cash flow. So that's that legacy piece. So we want to make sure that that is handled. You're comfortable with that. For then simultaneously with your body being balanced, you're able to kind of achieve everything that you want in life, and that's kind of the key there. So, kind of to button this down on the last slide is again recalibrating on your return expectations and seeing if that pencils out, and then prioritizing strong deals. And again, we just covered that multiple times, and then getting that rate locked up as quickly as possible, so you have clear expectation, or making numbers, or making offers, and forecasting into the future. So then we know obviously where we're at, and then where we can take this into the future. So that's all I had today. So if anyone wants to, that has a property right now, we have a couple people to talk to about listings. We have a whole bunch of buyers we're working with. Get in touch with us early. We're right now um, we have there's a lot of opportunity to look at. You want to make sure that you're looking at the right one. If you're in a 1031 and you're kind of more of a rush situation, you want to get looking at stuff early as possible. And again, talking to a mortgage lender, even through even when you have your properties for sale, so you can kind of get an idea. We haven't seen the interest rate change much at all. So again, like knowing what that number is, start playing around with some different scenarios, and we can kind of play around with some numbers of what ideally you may net, what we can put into the new deal. You kind of have an idea, and if that makes sense, then now we know we have our buy box criteria, and we can start aggressively looking at opportunities. 2 calls ago, what was we talking about? Competing with REITs, all cash. They're highly targeting high cap rates in major metros. To counteract that, we got to look at a lot of deals. We got to look at secondary markets. We got to look at off market deals, and you got to look at a lot of opportunities. So you want to keep that in mind to make sure you put yourself in a good, solid position to make the best decision. So that's all I have for that one. And again, I'll cap it off with just grab a copy. More information is better than no information. Get on the list, and we'll send out as much information as possible. Get in our newsletter. Please send this out to as many people as you think will get value from this. You can just send them the link, have them give us a call, have your connection call us, contact us, and we'll put them on the list, and then get some information out to them, and then join us again on our streams. So for sure, do it Tuesdays. We're playing around this week to see if we do Monday through Friday. So far, my voice been holding up, not so bad. And I don't think I'm annoying everyone that bad. So hopefully, I don't get too much bad reviews. At the very least, buy the book, then you don't have to hear me talk. Just as a joke. But I just want to be able to just put out as much information. I was just going through all my content for the year, and I'm like, I got like 100 different topics, and this is just like all of the different questions and conversations. I was just kind of just flowing. I'm like, it's just To think of a net lease where it is triple net lease, tenant pays all the bills, you just get a rent check, and where most or if all of our clients don't even visit the property, it's not a real sexy thing. To have as many questions, it's like kind of crazy. But we're talking about commercial real estate. It's a big asset. We're talking about big business that's renting from you, and it's a lot of money invested. You work hard for it, so we want to make sure that you get all the information you need to make the right decision. So again, we appreciate it. Love your feedback, comments. I love the feedback we're getting so far. And like I said, we look forward to continuing this. So look forward to chatting with you tomorrow. And have a great day. Peace out.